Okay, so I'm glad that you're liking the trading view. So let's get into what's going on here today. So are we going to see limited participation in the Forex markets? 100%. The bank holidays are going to certainly dictate that, but it's still worth looking at some of the longer term time frames for setups that we might be looking at come Monday. And then the difference between spot and FX and even the currency share ETFs. I'm here to tell you, you don't have to trade Forex to trade currencies. But I will tell you that if you are trading currencies, I don't want you thinking that your main important price levels, for example, in the Euro US, are going to come from EC or FXE. You got to keep an eye on the main market, which is going to be the spot, but then feel free to execute your trade however you'd like. Meaning, feel free to look at FXE or options or EC or options. So those are always alternatives. Okay, so let's dive into it. I'm going to start with the Forextra this morning because I got a lot of questions about that. Let's cover our Dow day trade from yesterday. That one was pretty easy because by the time we got to the open, and this is a recap for those of you that are joining me, we put this trade on every morning. And so you might say, well, why is a currency trader looking at the equities markets? Well, the answer is really simple. In order to understand oftentimes what's happening in a number of key markets that are sensitive to risk appetite, you're going to look at primarily four markets: the COMDOLs, the Aussie, Canadian dollar, New Zealand dollar, and the yen. Now, I think a lot of people already know about the yen equities relationship, but what they don't necessarily know is how we handle that here in the room. I will always start with my assessment of what's happening with and to the yen with what's happening in the Nikkei first. That's what's happening in the Asian session. Now, yesterday I said, hey, we've had a blast. The Nikkei until basically yesterday. I'll just say yesterday. This was the day right here. I'll give it a bright red line there. Everything until yesterday was a blast. Fade, 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 fade. I mean, we've been fading the heck out of the Nikkei to the long and short side pretty much all year long, all through the first quarter. And it was valid because of the underlying market trend. And it was valid because we stayed within the range parameters. In other words, when the market put in a high and low, we pretty much stayed within that range. So it was easy to take advantage of overbought, oversold until, like I said here a few days ago, no joy if we make it through 18.5. And that's pretty much what we've done. We made it through 18.6, made it through 18.5, and now this is more of a fresh downtrend. And that's what we're dealing with now. Which means that if we see a drag on the Nikkei during the Asian session, we're going to see, for the most part, yen strength during that Asian session as well. Here's the one-day relative performance early in the US session, but still being influenced by the last major financial center that was open today, which was Japan. And you'll see the yen is sitting atop the one-day relative performance. Why would that be? Risk aversion, gang, risk aversion. So where is that risk aversion coming from? I think it emanated from how equities are moving abroad, the Nikkei specifically. And then I just kind of passed the baton to the US markets. And what kind of mood are the US markets in? They're moving lower. So that brings me full circle back to, well, why does a futures trader, why does a Forex trader look at this futures contract and trade it? It's going to give me a lot of insight into what kind of mood a lot of my currencies are going to be in. And oh, by the way, this is a great trade that we take pretty much every day. Okay, so question there. Salvi asked, wasn't I long the Nikkei? Oh gosh, yes. And let me go back. I'll tell you what I've been doing. You can look at the chart. I've been in and out of this Nikkei over a half dozen times this year alone on the daily time frame. And most recently, you're right, most recently, we had taken a short, got long again, played a midpoint, and I was still long. I took a little profit out here, okay? And I was still long, got out on a break even, and then got in again within the span of about 3 days here. And then I had my last trade. And it's funny you asked that, because it's a great question to ask, Selvi. So at some point, are we going to have that one last trade? Yes. You know, what did we do throughout? I'm going to show you just a handful of the trades that I took. Okay. And then finally we have, we broke the level right here. Playing this range, again, about over a half dozen times has been very profitable as we take advantage of the highs up in here along 19.5 to 19.6, and then taking advantage of lows between 18.8 and 18.6. Okay. Finally, I'm going to have one of two things. What gets us out of a trade? Hitting a stop loss, yes? In this room, a stop loss is generated by, one, an understanding of the typical price movement range of that symbol, and two, when the trade itself and that strategy that I'm employing is no longer valid. So next, the next decision I have to make is when the market breaks the validity of what is chop, when it exceeds the oversold level, at that point I got to say, well, if the range isn't going to hold anymore, is it even valid for me to continue to fade it? No, it's not valid for me to even continue to fade it. And when the market trend starts to look more like a 4 to 6, and when I end up with a lot more red grab candles like we have here, I have to accept that my tools are telling me there is a shift in the underlying market trend. And therefore, the best thing I can do, and this is always the best thing to do once that not only do you get stopped out of a particular trade, but you see that the signs that the underlying market trend has shifted, get rid of the old notes, abandon what it was you were once looking at, just ditch that paradigm, because this is a fresh downtrend. So yeah, Salvi, to your point, we had a number of buys and shorts in the Nikkei, and now we're dealing with a total shift in the underlying market trend. And now I'm going to focus on a different strategy, which is going to be, of course, our swing shorts. Where's the level that when we bounce up to, I could take advantage of a trend following swing short on a correction? Okay, so that's that. All right. I like these ranges, says Brian. I feel the risk is easier to define. Brian, I think it depends on the quality of the range though, right? I mean, if I had to go over to the US, which, the US, the Nikkei have a very similar story. I think the US range was pretty easy. We went in pretty heavy at a time where most people would have thought this buy that we had at 146 was insanity, right? But then when I saw this low here and essentially a double bottom, I thought, you know what? Very well-defined range, to your point, and very low risk. Awesome. I know that either that level holds and I'll factor in an hourly or daily price movement range, or it doesn't. So I had a very defined floor. Now, not all chop is going to offer us a defined floor. That's the challenge. Some chop might offer us multiple levels that we could see exhaustion at. And that's when I've got to use tools like my stochastic or like a ready aim fire to help me discern which one might be the level that I need to respect and get out at, right? That's where things like that are going to help as confirmation or filter tools. Okay. All right. So the back to the YM. Again, let me just walk you guys through the mechanics, and then we'll kind of take a look at what else you've got going on. So today's session is going to be a little different. It's not really an active trading session, but I thought it's a great time for me to have an open house, to review some things for some of the newer, simpler Forex members, and just take whatever questions you guys might have. All right, so you can see the setup from yesterday, and the review is this. At 9:30, we have our pre-market highs and lows. We have our clearing highs and lows by 10 o'clock. Literally the end of the 9:59 candle, we have our clearing range highs and lows. Now, here's the important part. And I think for a lot of you that like momentum in the morning, like I do, for the first 30 minutes of the day, I assess where the momentum breakdowns may be. And that next 30 minutes, between 10 and 10:30 Eastern AM, I look at momentum through, unless, and this kept us from a lot of trouble yesterday, this rule of mine, right? So let's go to the auto chartist. This is how we look around corners, gang. This is how we look around corners. I feel like my cat, I think cats can see around corners. Can they not? They're not really of this planet, but I'm pretty sure cats can see around corners. This is how we see around corners. Let me show you here. Okay, so I'm going to grab the YM. Now, for those of you wondering, Rog, why do you trade the YM and not the ES? There's a number of reasons, but I can tell you it just boils down to this very simple one. I'm just better at it. And sometimes as traders, we do need to just accept there are certain things that we're just better at. Is it ideal? Do you wish you were better at other things? I imagine. But, I was teasing a friend of mine. She's a swimmer, and many of you probably know, I have a friend of mine. My bestie is an Olympic swimmer, and apparently they're opening up some of the distance swims in the Olympics to women. They didn't always have it available to women; it was men only. The really, really long distance swims. And she tweeted how excited she was, and she wishes that was available when she was swimming. Well, her specialty is the splash and dash. In other words, she swims one length of the pool as fast as she can, right? I said, what are you talking about? You don't do distance. We were having a good chuckle. What did she do to become one of the best in the world at her particular distance and at her discipline, her stroke? All in. She went all in on that. If there was going to be a single length of the pool in either freestyle or butterfly, she was either going to win it or she's got a record in it. I think at 44, she set an American record in the butterfly for that, So pretty funny where I have to tease my 5-time Olympian friend going, what are you talking about? You went all in on your strength, silly. And we had a just good chuckle about it. But I'm going to tell you guys the same thing here. Go all in on your strength. When I look at the E-mini S&P, my success ratio there isn't anywhere near what it is on the Dow. Now, there's a number of reasons. The bottom line is I got to go all in on what it is that I like and what it is that I am good at. And I think the Dow is a better barometer for the overall health, psychological barometer for the overall opinion and health of the markets. I know that's a very different opinion than a lot of people have, but I think the S&P has become so tech heavy. Some days it behaves like the Dow, some days it behaves like the Nas. It's got a funny makeup now with how heavy it is in tech. So it's not the S&P of my youth, that's for sure. The S&P of my youth had an 80+% correlation with the Dow. I don't think that's true now. Okay, so let's see, a couple questions here. I switched from ES to YM, never even looked at YM, really improved my results. Brian, I think one of the main reasons is the way in which it adheres to major psychological levels. And again, I think the S&P Well, hey, look, there's a lot of people that say, Raghi, you're crazy. And maybe I am. But the thing with the S&P is I like the way the Dow trades in single points, not the quarters. And I like the way it tends to really respect the major psych levels. It just is a more predictable market. I mean, that's what I've found throughout my years. That's what I've found. And so kind of going back to one of the rules about trading and clearing, okay? Take a look at this chart here. I know for those of you in the SFX room, you guys are really familiar with this, but how many of you in the open house room today have never seen me use these price movement ranges? Because I'm going to tell you something right now, gang. And this is not hyperbole. Number one, this is a free tool. I have no affiliation with these people other than I've known the guys who've created it for well over 10 years, and I think of them as brothers. Okay? Have any of you not ever seen this? Because this stuff is a game changer. Okay? And I'll show you how to get it for free in a little bit. All right. So notice that the upper end of the hourly price movement range is right around 67, somewhere between 65 and 70 points, right? And let's see, ES is algo driven. Absolutely. I agree. I think a lot of markets are being driven by that, but I think the algos don't necessarily break the rules of the major and minor psych levels. And a lot of algos, if you look at the way in which the market, the marketplace, the psychology, when the markets realize what, say, for example, high frequency traders really do, which is just kind of technologically jump the line. They take advantage of the way orders are routed. You know, even the algos really aren't that original. The things that they're doing were things we used to sort of do when traders in the back office would deal with traders in the pit. Same thing, but now it's become smaller increments of the market and at just mind-boggling speed. So that the things that algos are doing aren't that different than the things that used to happen. It's a little different, but it's not that different than what used to happen between, say, back office traders and the floor. But here's the thing, unless you are trading very short-term time frames, I don't think you're going to really notice the HFT shenanigans. And if you're trading longer term time frames, one of the things you've probably realized is that it just increases the overall price movement range and volatility. But then that's when information like this, which is adaptive to that increase in volatility, shows me, okay, the nature of the markets are changing over time. Some things are becoming more volatile. Some things are becoming less volatile. And historically, they move a certain way. And this is really fantastic. Okay, so even spoofing is really just an algorithm. To your point there, spoofing is just an algorithm that you'll see in markets that are just looking to outpace other market participants. I think a lot of what's happening on the algo side, on the HFT side, is just really how can I understand order flow between exchanges and jump the line? I mean, if you really want to boil it down to basic stuff, and it really isn't all that different as to what it felt like to be in the pits and be a back office trader. You know, and so, you know, these spoofers, what do? So for those of you that don't know what spoofing is, and thanks for bringing it up, spoofing's basically they'll just put a lot of activity at the bid or ask before they cancel. They'll make it look like there's a lot going on there before they cancel. So they'll create like this attraction, this action around a particular price zone to get other HFTs active. You know, it's almost like bait, right? If you've ever gone fishing, they throw a shiny object out there and then they disappear. And they'll take advantage of that rally or sell-off, and we're talking small increments. So they're manipulating the market. By the way, you know what's really interesting? Back when level 2 was this new shiny thing for us traders, and we would see Goldman sit at the bid showing 100 shares or 1,000 shares or whatever, and then they'd really be on the offer getting rid of something, so they were kind of playing level 2 once they realized people were watching. Is it that different? It's really interesting. It's really interesting. So I don't think the games are new, just the technology is changing the pace of it. So yeah, we do have the data coming up pretty soon. Far, gang. And I know this is not like a typical trading morning for us, but good discussion. And, for a market junkie like me, when the markets are closed, I feel like a dragon slayer with no dragons. So it's good to have some company. All right. So if you guys have any questions, just keep them coming and we'll keep looking at the markets. But so I just showed you the hourly price movement range. If the clearing high low between 9:30 and 9:59, the end of the 9:59 candle, if the clearing range high and low exceeds that 65, 70 points, I will not play the momentum breakout breakdown. So yesterday, when we got this break through 538, I said, don't take that. Don't take this breakout. Wait for the pullback. So instead, what do? We did not take this. We took this, right? We did not take this, right? We took this. And then after 11:30, I'm done. When the European markets close and we enter the lunchtime doldrums here on the East Coast, I'm done. Now, could you trade the afternoon? Sure, you could. I typically say avoid 11:30 to 1:30. That's usually my choice. And if you're going to trade the afternoon, the only trades that we had in the afternoon, and a few of you emailed me and told me you took it, was the wave reversal here, and then the trend follow, swing short there. That was it. We had another opportunity almost here, and that was it. The only thing we did in the morning was buy on the pullback, and then once we broke the support of the wave, that was no longer valid. If you were going to kind of bend my don't trade rule, you could have taken a short, but once we broke the wave and started plotting red grab candles, the only thing you can do is short. So directionally, the wave and the grab candles keep you out of trouble because you're going with the dominant psychological kind of flow of the river, if you will. And that was pretty much yesterday. But after 11:30, I'd say almost every time, I won't say every time because there are exceptions, but nearly every time, I'm going to be done. I've taken my points out of the market. We didn't get a lot of follow through up through 550, and I'm done. And some days I know that all I'm going to get out of the market is a move from, for example, in this case, all I'm going to get out of the market is maybe a move from 520, 515 to 540. I don't really get out of bed to grab 35 points in the Dow. That's not what I'm looking for. But this week alone, we've had a couple big moves, triple digits too, right? So you don't wake up going, oh, today's going to be a triple digit Dow kind of clearing range day. You don't. It may start off as a rinky-dink little trade that took you for 12 points. And then you look back 90 minutes later and you've moved 112 points, right? So we always take the trade, we always manage it, and then we see how far is far. That's it. Okay? All right. So that's the Dow so far. So we're getting our data coming out right now. Again, low participation, but we are getting CPI, core retail sales, and retail sales numbers. So what are these numbers going to tell? Oh, these are not healthy numbers at all. So I would say, let's go to the euro for a minute. I would say the euro is going to like this. Why? Because the euro is an inverse look and a larger look at the US dollar. The number one way traders trade the US dollar on this planet, I can't account for any others, but on Earth, this is the number one way traders express an opinion about the US dollar against the euro. This is the largest market in the largest market, gang. Now you can look at dollar index DX and you can look at UUP, but those are just other ways of looking at dollar index or the US dollar against a basket of other currencies. This is the number one way traders decide to either play euro or play US. So it's no surprise we're seeing a move higher because this would be a negative to the dollar for sure. Okay, so you might say, well, I can't see any movement on the dollar. That's very true. That's why, as Forex traders, we know How is the dollar going to respond? What kind of mood on Monday or even the Sunday open might we see on the dollar after this kind of data? Well, we're already seeing it. The dollar's being sold. Not a lot. We've moved about what? From 106.06 to maybe, to 24. Is that a massive move? Well, let me show you. What kind of move would I anticipate in the euro, reflecting what's happening in the dollar, on an economic release day like this? You can see around corners again, gang. Let's look at the hourly price movement range. I'm going to be expecting on average somewhere between 26 and 35 points. 26 and 35. Let me show you. This is the column right here. 26 and 35. How do I get that? The average and the upper end of the average. This band across each one of these bars is the average, the high and low. And by the way, this is a 68% probability. Roughly 2/3 of the time, this is the kind of price movement we're going to see. This is not giving you directional insight. It's giving you insight into volatility. And with all due respect to things like ATR, this beats the pants off ATR. It's a completely different thing. It's historical tendencies. So what do we just move based upon the volatility? About 106.06 up to almost, we moved actually less than 20 pips. Well, if you're ready for 26 to 35 and you get less than 20, well, from a volatility standpoint, the wheels aren't coming off the wagon. Most bad decisions, and this has been my experience trading with and training literally thousands of traders from Toronto to Korea, Toronto to Seoul, you name it. I've been there and I've traded. And one of the biggest reasons people deviate from their trading plan is unexpected or misunderstood increases in volatility. In other words, people don't know when the volatility is going to hit because they're either ignoring the economic calendar or, things just broadside us like they did the other day with the president's sound bites about NATO, dollar, the Fed, and China. Okay. They either don't know it's coming, and that happens sometimes, or they haven't quantified what the move could be. What are the upper end moves in Euro US? There is a historical expectation. And if you understand that, you really do know what's volatile and what's just normal price movement. Okay? So nothing really crazy here. Let's go take a look at dollar yen. Okay, so again, dollar weakness, risk aversion. So yen strengthens, dollar weakens, and we see a pretty sharp move to the downside. And again, I could go right back here. Let's look around some corners again. Is this beyond the price movement range of about, on average, 32 to 40? 32 to 40. Well, we sold off from almost 109. So 108.93 to 108.70. Hardly a ding. Okay. All right. So let me show you how to get Auto Chartist. Again, I'll show you a couple different ways to get it. I've been a content contributor for Auto Chartist. I've been a huge advocate, their number one fan and instructor. So I'm biased. I don't think anything on earth does what my two good friends over at Auto Chartist down in they used to be in Johannesburg many years ago, and now I still think the office is in Johannesburg, but the owner now lives in Texas. I am a huge fan of what they do. So this is how you can get it for free. Now, there's a couple things you can do. Let me just mention this. I don't know how many of you trade with any one of these brokers. Now, I have traders in the SFX room, both in the U.S. and outside the U.S. There are a whole lot more Forex brokers outside the U.S. Okay, so this is the list of partner brokers that Auto Chartist works with, and you'll get the service free through that broker. I think, Awanda's here. I think Thinkorswim has a very limited version of this. All right. What else is in the U.S.? I think GainCapitalForex.com, there they are. They still work with them, okay? But what I would recommend is this. So you go to the home page, okay? And Kevin, to your point, yeah, once it turns into delayed, that's fine. For what I use it for, I have a real-time account. I mean, I've worked with them forever, but I actually use the demo here in the class so people know, oh, well, Ragi's got real-time and I've got delayed. The delayed is fine for the volatility analysis that we do. It's absolutely fine. Where it's not going to be fine is, and eventually we'll do something on it, but if you choose to use the chart pattern results, then you need the real time. And it's a very inexpensive program. But then you need the real time results. Okay? So that's where, and at some point, that would be a fun thing to do. That would be a fun thing to do. Just kind of look at some of the chart pattern results and Fibonacci levels. And there's some cool things this thing automates. Very cool things. But I'm talking about just the volatility analysis. Okay? 24-hour delay is fine. So register here. You're not going to get weirdo calls and weirdo emails. You're not. These guys aren't like that at all. But what I will tell you, here's the important part. Listen up. Here's the important part. Do not choose one of these brokers. Let me say that again. Do not select a broker. Even if you have them, do not select them when you're signing up for the trial. Put other or I do not have. Okay? One of these two. Otherwise, if you choose that, they're going to direct you to that broker. I like the direct version from AutoChartist. Now, certainly, if your broker has them, let your broker know you're very pleased. Support AutoChartist. If your broker doesn't have them, call them up and say, why the heck don't you have this? I want to see around corners. Okay? But register, and then for the first couple weeks, you'll have real-time data. Check out the chart patterns, check it out, have some fun with it. But after that, what's going to happen is it will just basically sort of demote your account access to delayed. And that's absolutely 1000% fine. And that's it, gang. Easy peasy lemon squeezy. And that is it. So if I want to see around corners on dollar yen, I know what the hourly plus or minus is. We're selling off. That's zero surprise. A data miss would be what? Risk aversion. So you typically would see equities weakness and US dollar weakness in this case as well. Because while sometimes the Dow and dollar do move inverse to one another, in this environment right now, the market is desperately trying to figure out whether or not the Fed is open to interest rate hikes in June. Okay? So we're going to see the market sell off a negative data because we're going to think, all right, the FOMC is not going to like the fact that we're seeing weakness in the data that doesn't support their wanting to be increasingly hawkish. Having already hiked in March, though, could open the door to at least another 2 hikes, maybe 3 this year, June, September, December. Now, the president did come out, and it's unusual for presidents to comment on monetary policy and the currency. It is unusual. Think about it. How often did President Obama talk about the dollar? This is not political, gang. I am very not political. Everybody in the SFX room knows my respect for anybody in DC, is like -4. Okay? I don't care what party you're affiliated with. So if your lips are moving, you're lying. All of them. So with that in mind, this is not political, but it's unusual for a president to comment on monetary policy with the frequency and vigor with which our current president does. So that's a little unusual for sure. But I think he came out as a dove. Remember, this is the same guy who said the Fed's behind the curve and that Janet Yellen is toast. And that also China's going to be a currency manipulator. The funny thing was, by the time the president was inaugurated, if you actually do the mathematics of what it means to be a currency manipulator, China is not a currency manipulator. You know who actually is? Europe, the ECB. I would not say the PBOC in China is manipulating the currency, not when you crunch the numbers, but the ECB is. interestingly enough. And a couple of the countries on the currency manipulator watch list are Germany, are Switzerland, and actually Korea as well, South Korea. So interesting names there. Okay, so with the president commenting on the fact that he's okay with low interest rate policy, well, what does that mean? Does that mean we stay at 1%? Or does low interest rate policy mean anything, say, under 3%? We don't know what that means. And so what was already a confused situation for what is the FOMC going to do in June, and really, can we get another 2 or 3 rate hikes this year? Now the market's wondering, well, does that mean we're not going to see as many rate hikes? And Janet Yellen's tenure is going to be extended, and she's kind of an uber dove, so maybe just 2 hikes? The market doesn't know. I will say that US dollar did not sell off dramatically on that. We actually just hit a medium-term range low and 100. What is possibly going to be maybe a larger impact on the US dollar. For those of you that are wondering, okay, Rog, what's your outlook going into the latter half of the year? I am actually a dollar bear. And the reason for that is the minute the ECB announces that they're going to begin taper, like an organized official taper, the euro is going to rally. The euro right now, and I think I was talking about this in the SO room just a few days ago, the euro right now is kind of circa 2014, early 2014 in the dollar. Where the euro's at is kind of in kind of this zone, because they're getting ready to possibly begin. And that's what we were dealing with here, right? The taper conversation. I'm not saying this is the move we're going to see in the euro, but psychologically speaking, that's where we're at. So yeah, I'm a euro bull. And here's the thing. If you're a euro bull, you have to be, on the other side of that coin, a US dollar bear. And if we were already readying ourselves for potentially 2 or 3 hikes out of the FOMC this year, and we weren't even pressuring the range highs on the dollar or the range lows in the euro US, the news of this week reduces those chances much more. So when it comes to longer term plays further out, I'm looking to get long euro. And by the way, I'm looking to get long pound against the US dollar as well. Okay. All right. So I think another thing that's going to give, to your point, Brian, I think another thing that's going to give the euro a shot in the arm is when we just can finally stop spinning on these French election Le Pen narratives. Okay. By the way, speaking of that, I am getting close to my zone, my aggro zone of buying EWQ. This is the MSCI iShares for France. I've been playing this one on and off throughout the year, getting long, and it's been a pretty good trade, and we're finally getting a pullback. Now realize that play on the handle at 26 that we're dealing with right now is one of 2 levels that I'm interested in. I'm also keeping an eye on that 2580 area as well. So in the back of your mind, realize I'm ready and actually even would like to see about a 20-cent wiggle on this setup between 26.05 and 25.85, and I'd like to build another long position. By the way, EWU, which is a play on the UK, is also coming back to some levels that I'm interested in. I've been in and out of this one, playing the basically the FTSE for some time. And I'd like to get long again, because I think even though we're still going through a lot of Brexit uncertainty, we have actually baked into the cake and discounted so much possible, just calamity, that it's kind of tough for the market to really get that freaked out about the UK economy. And some parts of some kind of circles within the market are realizing that the UK has a very interesting and probable scenarios becoming a tax haven, and also the more people look at this post-Brexit economy and they hold a microscope or they hold a magnifying glass over Europe and then hold it over UK, Europe looks more troubled than the UK does. Greece still rears its ugly head in terms of the financial narrative. Italy still rears its ugly head in terms of the financial narrative. So when people take a good look at this post-Brexit economy, they're not freaking out when they look at the UK. And I do think longer term, these are places that I want to start getting long in. We've been playing the range in the pound for some time, but I'm really looking for this pound to break above the 200 period simple moving average, get above the 127 handle, start to look a little bit more like an uptrend, like it slowly is in pound Canada, and like it slowly is in pound Kiwi. And I want to start to buy pound. I might be able to buy pound in pound Canada and pound Kiwi before I do in pound US. Am I okay being short US dollars? Yes. Yes. Because again, when we were still talking about 2 or 3 rate hikes, it wasn't like the greenback was pressing its range highs at all. All right. Okay, so that's what's going on there. Let me keep up with some of the questions here. Will the yen benefit from the 830 data? Yeah, it'll strengthen. Let's take a look at the one-day relative performance here. Yeah, it's going to continue to strengthen. No question. That was negative data. The US dollar is not going to benefit from that, which means on the other side of that, the euro will get pushed up a little bit higher on the relative performance for today. And the yen's going to continue to be all sorts of tall and awesome on the left side. Absolutely. Yeah, I agree with that. Is there a way to play EWQ leveraged? Is there a leveraged France ETF? I'm not 100% certain. You know what? Let's do this. It's a good question. Let's just Google it, because the Google knows everything. All right. Let's take a peek. So the only one I know of is EWQ. But let's see what else we've got here. The one that I know is, trades with decent volume is EWQ. The average volume is only about 600,000 though. So let's see. iShares, that's that one. See, then you go to the Eurostoxx 50. So now you're starting to dilute the specific French story. So I'd say no. Brian, I don't even know of another way to play France like that, to be quite frank. All right. Cat Courant, yeah. You can check with your futures broker and ask them what access they give you to the CAC 40. Yeah. You could ask. Now, I don't know who you guys trade futures through. Right now, I do most of my futures trading through TradeStation. I'm looking forward to Tastyworks getting futures, but for now, yeah, that's it. All right. Now, if you're outside the US, oh yeah, go the CFD route. Absolutely. Or you can actually trade this through the futures abroad. I mean, there's TradeStation is available abroad, and you will have that. You bet. Yeah, if you have CFDs, I'm insanely jealous. Absolutely. If you're outside the US, yeah, go for it. No problem. And that's the other great thing about the futures. There are ways you can trade every one of these markets that we're talking about outside the US as well. Okay, so I will be open to some of these pullbacks. In fact, once we get above the 180 handle on pound versus Kiwi, I will consider playing a pullback to say the 178 handle. Now, for those of you that are saying, okay, Rog, I get that you're a Forex trader, but I'm not. No problem. But like, humor me for just our time here together, because here's one of the issues with currency trading in the US and currency trading, period. Most traders, and I think this happens abroad as well, focus on the US dollar versus whatever. They're always focused on the majors. Essentially, they kind of pigeonhole themselves into this column right here. I'm trading the US dollar versus everything else. Well, when you look at this whole view of what you actually have access to, you're leaving a lot of the market on the sidelines when all you do is focus on this column, right? And sometimes, and I use the word contrast, sometimes your best contrast is not whatever versus US dollar. In other words, the reason this trends work and last so well, because that's one of the things I think most market participants agree on. The trends on the Forex side, they're monster trends. When they get going, it might be like a freight train, but once it, kind of slow to start, but once they get going, they're significant. And the reason for that is there's always two narratives at work, because there's two markets at work. We're not trading a single unit. We're trading two things. So if I can find on one side of the currency pair strength, in other words, I know it's something versus something, right? If I can find strength on one side and I can find weakness on the other, I buy this, I sell this, I'm getting two things working for me. That's why the trends tend to be what they are on the Forex side. So how do I take this analogy and apply it here? Well, if I want to buy US dollars, I might look at selling something that's weaker than it. Now, the heat map is not going to be the sole determining factor for this. I'm going to look at the charts. I'm going to look at the trend, things of that nature. Okay? The yen is one of the stronger currency stories right now. Why? Because we're seeing fatigue in the Dow. We're seeing fatigue in the Nikkei. So that's one of the reasons the yen is so strong. And it's easy to buy yen and sell other stuff, right? That's been working pretty well. That's what I mean by contrast. So don't always assume that something versus a dollar is going to always be your best bet. When I talk about, pound Kiwi or pound Canada, I'm trying to take advantage of just currency stories that have been generally weak, so I can sell those against something that I anticipate or is very strong. Now, some of you might say, well, Rog, the Canadian dollar's been pretty strong. That's true, because we've seen what's happened with crude oil as their central bank, if you will, OPEC, has done a very good job talking their currency, crude oil, up higher. I am going to do the same thing that I did throughout much of 2017, which is once we get up to about $55 a barrel, I will buy puts and I will short this thing. So I would definitely like to find myself up in this area. Doc asks, what about pound Aussie? Oh, great question. So the Aussie, up until about a week ago, up until about the recent RBA meeting or RBA event, was actually one of our stronger stories up until recently. And it is starting to get a little bit more clarity as a weakness story. That is true. You can see it on the heat map, and actually you can see it on a number of charts as well. But here's the problem. If the Nikkei resumes or finds a floor and starts to rally, if the Dow maybe goes and touches the bottom of the range around 20,356, if the S&P heads down lower to 2317, 2320, and we bounce, the one calm doll that's been very sensitive to the risk environment has been the Aussie. So risk aversion has weakened it, but risk appetite could bring it back. So I'm a little bit more hesitant about the Aussie, Doc. And I know the Canadian dollar, well, the Bank of Canada, the BOC, is going to likely be open to potential rate cuts. So that's a Canadian dollar weakness narrative. And the New Zealand dollar, with the global dairy trade, that's their number one export and a big part of their economy, has been struggling. So that's been a pretty easy short. So that's what I'm focusing on, those two calm dolls. And anything else that might start to weaken. The pound US is in that list too. So I'm watching the Aussie doc, but I'm a little skeptical about whether or not I'm really willing to play it yet. But there are a number of trends in the Aussie that are much clearer Aussie shorts, like Aussie yen. There are a number of them. So that's the other thing we have to ask. What's the driver for the interest we have in the pair? Is it Aussie shorts? Because there's better Aussie shorts out there. Or is it a pound buy? I think there are better pound buys out there, right? So at some point we do ask ourselves, we dissect the two currencies and say, okay, I'm looking at, for example, Aussie yen. Is this the best yen buy? It actually, I think, is. Is it the best Aussie short? That is true too. When I look at the pound Aussie, I ask myself, is this the best pound buy? It's probably top 3, not the best. And is this the best Aussie short? No, I already know the Aussie yen is far better. So at some point, I do step back and say, okay, let's look at each individual currency story on its own. And is this the best iteration of what it is that I want to do, buy or sell? So great question, though. All right, next question. For the expected price range on AutoChart is it essentially ATR for the various time frames? It's, I think there's a number of ways we can describe it, but really what it is let me give you a backstory as to when this was presented to me from the guys over at AutoChart. They said, Rog, we're known for chart patterns and we've been crunching chart patterns for forever. I said, yeah, that's true. You guys are the chart pattern platform. I don't think anybody holds a candle to what they do. And I said, what's up? And he goes, well, we have all this data that our servers crunch. And we were wondering if there's anything else we could do with the data. And I said, oh, cool. What did you decide? They said, well, we can actually go back, 1 month, 3 months, 6 months, and look at every currency and what it typically does between, 8 and 9 a.m., 9 and 10 a.m., 10 and 11 a.m., and just give traders an idea of historically what it does. But it's historical looking back 30 days or 90 days or 180 days, right? Think of your typical ATR reading. Somebody give me a typical ATR reading, just for our example purposes. On a daily, what would be your typical ATR reading? And I don't use ATR, so that's what I'm asking you. What's somebody's typical average true range setting for a daily time frame? You guys tell me. 14? Okay. All right, cool. Thank you very much. Okay, 14. So that tells me what? I'm looking back 14 days. I'm looking at the range, the volatility that I've seen for the last 14 days. So if you were to set your ATR to 30 or even 20, reflecting a 20 trading day month, 20, or if you were to set it back to 60, right? Think about how often do you hear people talk about average true range readings that high? What I'm talking about is when I look back over the course of months, factoring in non-farm payroll volatility, factoring in FOMC meetings, factoring in, all sorts of data. And in some cases, over the course of months, so multiple FOMC meetings, multiple non-farm payrolls. That's the data that's reflected here. So if you have a 14 ATR reading in front of a non-farm payroll Friday, your average true range is not going to reflect what the market could do on that Friday. Does that make sense? Because it just doesn't have the data. And worse, when people use an even shorter ATR reading, and we go into that narrow sideways chop that we often see accompany the anticipation of the kind of wait and see in front of a major event, that ATR is skewed to a narrower range because the market has gone into what I call guillotine syndrome. The market's just kind of gone all quiet, and it's not moving a lot. And then all of a sudden we're going to have a volatility explosion, and that ATR is not going to reflect what the range could be because it doesn't have the data to reflect it. It would have to be looking at the previous time non-farm payroll came out, or at least a few of them. That's what this does. And I will tell you, again, I don't want to say this is good and this is bad or this is better. Let's just say they're apples and pineapples. Yeah? Okay. So a couple more questions here. And let's see. And it all relates to the time frame. That's exactly true. Salvi, thank you. It absolutely does. So if I'm looking short term, 60-minute time frames or less, or if I'm looking at the pair maybe right in front of an economic release, I'll use the hourly price movement range. But if I'm looking at a longer term time frame, I'll go to the daily. Absolutely. Absolutely. Great point, Salvi. Okay, so I think you guys, does that make sense as far as the ATR? Yeah, it's a very different animal, completely different thing. Do I think the dollar yen will continue to fall in US dollar weakness and yen strength? That's going to depend on, first of all, I'm still anticipating one more rip higher in the dollar. I absolutely am. And that means I'm still waiting for that day, that data. Maybe it's going to be non-farm payroll, that soundbite. Maybe it's going to be a series of FOMC, that FOMC flurry that we tend to get when Yellen and company are trying to communicate to us that something is fairly imminent, like they did before the March hike, right? If I get that kind of heads up, I think we're probably due one more rip higher in the dollar. Maybe go test 101. I want that out of the way with confirmation with a break of 99 on the June Fed Fund futures contract. And then after that, I'm going to feel pretty confident with dollar weakness moving forward, especially after the June election, French election. And again, it's still something I think the newspapers are probably. I think that the news in Europe loves Le Pen because she keeps interest. But the truth of the matter is there's very little in the polls that are suggesting she has a realistic chance at a victory. But then again, we also have a very healthy mistrust of polls anymore, don't we? UK referendum, US presidential election, right? We have a very healthy mistrust of polls right now. However, it's very unlikely that she wins. However, I think the newspapers and news want to propagate that potential because it keeps people tuned in. But after June, I think we're going to basically just move on. We had a very similar reaction in front of the Dutch elections when it sounded like the Dutch Trump was going to win, Wilders, and he lost. Like he got trounced. So, and I think that populist fear just sort of started to fizzle, and then that also fizzled when it came to Le Pen. But after the French election, I think the US dollar and euro start to behave a little bit more like I'm saying, which is euro starts to strengthen and dollar starts to weaken. Now, dollar yen specifically. So now, Doc, we're talking about a couple of the markets into the mix here. Does the Nikkei find a floor? And does the Dow find a floor and start to resume the previous rally that for now we're taking a breather on? I think so, yeah. Same FOMO quality in this market? No. Whether you want to call it the Trump rally or whatever the market's calling it, that's fine. That's fine. But remember something. After the November election, we got pretty bullish on the equities markets, especially the Dow, with all the plans that it seemed were going to come from this new administration. Infrastructure spending. The Dow became the popular kid in class. More so than tech. Because for a while, tech really felt that this administration and this president would not be a friend to tech. And I think for the most part, that fear has been kind of pushed aside, obviously, right? But I think tech was a bit of a laggard until they realized, no, he's got bigger fish to fry. So I think what we're seeing now on the equity side, especially the Dow specifically, is this just constant spin cycle of here comes tax reform. Oh, but wait, we need to do healthcare first. Okay, here comes healthcare. Oh, nope, we lost the vote. Okay, we'll go back to tax reform. Oh, but really we need to do healthcare first before we do tax reform. right? And by the way, we're bombing the heck out of everything in the meanwhile. I'm doing a very quick Cliff Notes version of what's happened the last 30 to 60 days. And rather than just completely throw a tantrum, all the Dow did in a very classic Charles Dow kind of way is transition from a markup to distribution. And that's what we're in right now. This is a pretty classic chart pattern or market pattern, which is just distribution. Now, here's where a lot of traders, I think, well, this is going to sound like obnoxious, but they screw up. They forget something that we have as a mantra in the SFX room, which is this. Okay? And this is especially on the daily time frame. Intraday, it's a little different. Intraday, it's different. You can be a little bit more nimble and such, but respect the trend that was, especially on the daily time frame. So when I transition out of mark up, which is just Charles Dow's way of saying uptrend, and I transition to sideways chop at the end of an uptrend, that's called distribution. Distribution then just basically says we've got an overbought, oversold scenario within the context of the sideways range. So define the range, find the range extremes, and then go about trying to identify when you're going to get the exhaustion at either end. Well, if I respect the trend that was, I'm going to basically, this is the way I look at it, I'll be 2x my long positions, or you could look at it as my shorts would be at 1/2. I don't care how you want to look at it. By comparison, I'm going to have a longer, when I get long, I'm going to have a larger position from the support than I will from, if I'm going to fade the market because of the trend that was. Does that mean that I don't think we're going to turn into a downtrend? No, not at all. Not at all. Okay? And again, gang, I don't get into politics at all. What I'm telling you is the way the market is perceiving what has happened. Okay? I don't get into that at all. Whoever is our commander-in-chief is our commander-in-chief. That's it. What I'm trying to do is psychologically gauge how that message is impacting the market. That's it. I think one of the reasons a lot of traders, and I saw this amongst even my friends, they said, what are you doing with the equities markets? What are you doing with your portfolio with President Trump? And a lot of these people were just not happy, right? I said, I don't care who's president. What's the market doing right now? How's the market perceiving what this administration is going to do? Well, the market's rallying, but I don't know. I said, nowhere on and I've been long pretty healthy from about 17.8 in the Dow. And I said, nowhere on my statements, as I very happily collected over 3,000 points in the Dow, nowhere am I getting some sort of minus 10% because this move shouldn't happen, or it's not real, or, we don't trust the administration. Like there's nothing on my account saying minus 15% because the market shouldn't be doing this. That's what oftentimes it just makes me laugh. I don't care if the reason's real. It's perception, and perception is real, right? So I am aware that we're flirting with this area, but I'm willing to buy it, which means I'm also looking for potentially the Aussie to bounce and the yen to weaken. Now, if we break this level here, yeah, I realize that then what I'll do is I'll go back to shorter term time frames and trade it. Okay? So, Bob, to your point about confusion, I think we're seeing whenever the market is confused, I think we're going to start to see that more as a fear reaction. And that's why I say now gold is in an uptrend and I'll buy the pullbacks. And same thing with the 30-year. Because before that, I was willing to short these. And it was very profitable to short these. Even just, a couple of sessions ago with the Syria and North Korea headlines and the test of the 200-period simple moving average. I shorted that area and it was an easy peasy 20 points. I'll take that. And why is 20 pertinent to gold, by the way? Not that 20 points is what some magical, random thing. 20 points is the upper end of the price movement range for gold. Cool. Gold delivered to me the upper end of the PMR. Awesome. Thank you very much. Right? So when we broke the overbought resistance level, I've got to reassess. Kind of going back to Charles Dow. Are we shifting into a different market trend? Yeah? Okay. All right. So for those that are joining me for the open house, we were going to go about an hour or so. I'll take some more questions. Just kind of some just general assessment of the week, things that I'm looking at, things that have shifted, I think, in a dramatic way, in a market trend moving way this week. So that's the kind of stuff I wanted to make sure that we cover. And yeah, to your point, Brian, yeah, we've been here, right? That's a breadcrumb. That's what I call a breadcrumb down here. Yes, the Hansel and Gretel school of chart analysis. The last time we were there, we bounced. Well, I'll use that to my advantage. It's just support. And yeah, do I think we can bounce? Look, I'll expect the bounce until it's broken. Same thing like with the resistance levels on gold and the 30-year. I'll do the strategy that's valid because of the market trend, and I'll do it at levels that are still intact until they're not. That's all I can do. Right? And while buying bounces off these levels in the Dow haven't been tremendously productive in terms of just some monster points, they've been pretty good. They've been pretty good. I just have to acknowledge now that we are favoring the bottom half of the range and we are exhausting at the midpoint. And yeah, the overall narrative around the market has gotten a little bit heavy and concerned. And the Nikkei's rolled over, so I know there's going to be a little bit more, pessimism as we start each new day. Remember, the day always starts in Asia and then kind of, moves across the globe. So I know there's going to be a little bit of that impact there. Okay. So will I buy at the bottom of a range on a red candle? Yes, that's fine. The candle color isn't as important at the buy moment in CHOP. I just need to acknowledge that mostly the candle color that we've seen within the context of CHOP has been blue. That's more of our neutral candle that reflects that CHOP that we're seeing. But really what I'm playing, Doc, to your point, is the low, which is 20,356. And I can keep a really tight stop. I could use a daily price movement range. I could use an hourly. I can use what we call a range extreme, which is I calculate the potential low for the day based upon the current high that I have. I take the high, I subtract. I take the high and I subtract, here we go, the daily price movement range, and I project what a potential low could be if we were to pressure the average of the high of the range for that day. That's a really easy way to play stops and sometimes even play exhaustion levels. There's a lot of ways we can use these levels. Just depends on how comfortable you are with them. Okay? As far as touching on stops, please. Oh, absolutely. Jim, stops to me should be first determined by the validity of the strategy. A lot of people use percentages and points and pips, and I've never subscribed to that, ever. They'll say, well, I risk 10 pips for a 40-point gain. I'm like, what is that even based on? Some sort of pseudo, 4-to-1 risk reward or something like that? Yeah, so I find a true risk reward, if you're using support and resistance on the chart, seldom exceeds much more than 1-to-1. If I'm using the price levels that are on the chart, risk rewards seldom exceed 1-to-1. So the other thing that I think most traders don't consider is at what price is the validity of your trade no longer valid. So in the case of the Dow, if I'm talking about that 356 low, yeah, if I break 350, I really got to question whether or not the support that I need, those bids to stack up there, are showing up and are going to support the market and keep my trade valid. right? That's the validity. I know it's only 6 points away, but that would be part of the validity because I'm talking about an overbought, oversold market, and either price holds or it doesn't, right? Now, I could also factor in hourly price movement ranges to account for kind of the wiggle and the typical ebb and flow of the market. I could use a daily price movement range, extreme low. I could do those kinds of things. Sure. But generally speaking, my expectations for risk are going to be based on a couple of things. One, which time frame, right? My paradigm for stops on an hourly or intraday time frame is typically going to be using this particular graph and looking at the time of day. On a longer term time frame, 480 or daily, it's going to be based upon this and using the day of the week. Okay, so are there times I might be able to use an hourly price movement range in a daily time frame? Sometimes, but not as often. For the most part, if I wander into a daily time frame, my risk reward has to reflect pretty much at minimum an expectation of a plus or minus 120 points. And if that's too rich for someone's blood, you don't change your stop, you change your time frame. So, Jim, that's a kind of general look at my philosophy on stop losses, and it doesn't follow trading dogma, that's for sure. It is a little different, but I think it's what actually makes sense. Okay? All right, so with that in mind, let's go back. Mood, the euro is in, and the dollar yen. How much of the gains did the euro maintain? Most. Okay, interesting. And dollar yen, as a way to look at the risk environment, yen stayed pretty strong. Yeah, yen stayed pretty strong. Okay. Now realize dollar yen was kind of a double whammy because we got dollar weakness and we had yen strength on the data. Okay. All right. So, gang, I'm going to take another question or two and I'm going to wrap it up for today. Thank you so much for joining me. I hope it's been insightful and helpful, and I hope it's got you asking a few more questions and different questions about your trading process. And we do these open houses every now and then. And I hope it's been, helpful. Again, it wasn't an active trading day because obviously today is not an active trading day, but it was a really good chance to kind of pause, slow the pace down a little bit, and talk about what the markets have been doing. All right, Brian says, most of our trades have a huge risk reward, not one-to-one, especially playing well-defined cycle. I wouldn't say that, Brian. Not necessarily. Sometimes they're big, but then huge is what? Huge is going to be predicated upon the typical price movement range, right? So I'll be more than happy to break down the risk rewards on Monday. Yeah, we can definitely do that so I can get a little bit more specific to the ratio, but typically not. We don't wander into a trade that doesn't have at least a one-to-one to the first profit target. They're going to be big in terms of price movement because we're typically looking at a daily, right? So that, yes, is going to be bigger, but that's really more about the time frame. Does that make sense? But yeah, point one out because I don't know that we rarely, and even then I'll say it's aggro. So I can't remember the last time we wandered into something that from entry to initial profit target and from entry to stop was greater than one-to-one to the risk side. Okay? All right, let's see. Couple things. What is the hour of day along the bottom of the ranges graph equate to? Hour of day. Oh, see this drop-down menu here, Martin? I've got this set to New York. It relates to a 24-hour clock based upon the the time zone you're in. Okay? That's what that is. So great question. 24-hour clock and based upon the time zone. So this is, I'm on East Coast time. So this 0 is midnight, 23 is 11 p.m. Right? This would be 8 a.m. Eastern. This would be the 4 p.m. market close at 1600. So that's what that is. 24-hour clock based upon, whatever you've set here on the drop-down menu. Okay, of course, my pleasure. Next is, do I trade live in the room? Hey there, Skydiver Jim. Yeah. It's funny because Skydiver Jim, I see you in the SO room, right? By the time that I'm in the SO room and Europe's closed, most of our trades, because I focus, so now you probably have a better idea. My active trading hours are basically between 8 and 11:30 a.m. Eastern. That 3.5 hours, that's pretty much my day. That's all I need. The rest of the day I could just kind of walk out, take off. It's something for me to have a 12:30 tea time. The courses in Florida are usually pretty empty in off season at 12:30. I day trade the Dow almost every morning. So by the time I'm doing anything in the afternoon, yeah, everything's already been done, or we've already parked our orders, or I've already done my Dow setup. Yeah. So by the time I get to the SO room, the simpler options room at 1 Eastern, 1 p.m., yeah, I've done pretty much everything I would normally do. So yeah, I trade live in the morning. Yeah, absolutely. Or I set these up live. And then also I think it's worth mentioning that, short-term time frames sometimes give us decent entries, but I like longer-term time frames. I'm a daily chart kind of girl. I like trend follows on, 240s and 480s. I'm not for the most part a day trader. So not that there's anything wrong with it at all. I just like to let you guys know what I do and don't do, because if you like to day trade, I have strategies for it. I love to trend follow intraday on a 5-minute, but that may not be your cup of tea. So I'd rather you guys know now, so you don't spend time in the room going, oh, but she doesn't trade the way I'd like to trade. So that's why I'm putting that out there. But yeah, I do in the room. Good to see you too, Skydiver Jim. All right, so gang, I'm going to wrap it up there for today, all right? I'm actually a little hungry and I want some breakfast. I did see a question about a 60-minute Dow analysis. I don't have anything on the 60-minute that I really love right now in the Dow, because I don't have the market clarity that I like. 120 is a little bit better. The 5-minute was good on Thursday, yesterday. That was a nice series of buys for us, and a few of the traders took the shorts going into the afternoon, which again, 11:30 is really a big cutoff for me. It really is. Okay. All right, gang. So thank you very much for joining me on this day, on our holiday day. And I hope you guys have a wonderful weekend. Happy Easter. And I'll see my SFXers on Monday. And those of you in the open house, I did record this. And I'll shoot this email out I'll shoot the playback back to everybody as soon as I produce and post it. And if you have any questions for me, feel free to reach out to me at Raghee@simplertrading.com. Yes, I will email the link to the recording. You bet. Mort? Yeah, you bet. It is recorded, and I will send it out. It's roughly over an hour. Okay? All right, gang. Have a great one, and thank you so much for your time. Okay, be good to each other. See you soon.